All right, let's talk about credit cards. Chances are you think you know how giants like Visa and Mastercard make all their money. But what if I told you that one of the most common beliefs about them is just completely wrong? You hear it in the news, you hear it from politicians, all this talk about capping those sky-high credit card interest rates. And for an investor, that raises a huge question. If the government steps in and limits that 20-something% APR, does that completely destroy the business model for the biggest names in the game?
Well, here's the twist. The answer is no. Not for them, anyway. And once you understand why, you'll see a business model that is so much more brilliant than most people ever realize.
So, first things first, let's tackle this huge misconception head-on. What is it that almost everyone gets wrong about these financial titans? This is the one, right? We've all heard it. We've probably all said it. The idea that when you're carrying a balance, all that juicy interest is flowing straight into the pockets of the company whose logo is on that piece of plastic. And hey, it makes sense on the surface, but it's not the real story. And here is the absolute key to understanding everything. That high-interest debt? That's the business of the banks that actually issue the cards. You know, your Chase, your Capital One, your local bank. They are the lenders. Visa and Mastercard, they're something else entirely. They're the payment networks. Okay, so if it's not from your interest payments, where in the world does all their money come from? How does their business actually work? Look, it really boils down to this simple difference. The banks are in the lending business. They make money on interest from the debt that people carry. But the networks, Visa and Mastercard, they're in the transaction processing business. Their income comes from fees based on the sheer volume of money that's moving through their system. This is their secret sauce right here, volume-based revenue. What that means is for every single time a card is swiped or tapped or a number is punched in online, they get to take a tiny, tiny slice of that transaction. It's often called a swipe fee. Let's just walk through a super simple example. Let's say you go buy something for exactly $100. The store you bought it from, they don't actually get the full $100. They might get, say, $98. That $2 difference gets split up, and a little piece of it goes directly to Visa or Mastercard just for making the transaction happen securely and instantly. Probably the best way to picture it is this. Visa and Mastercard run a financial toll booth on the massive global highway of commerce. They don't lend you the money to buy the car, and they really don't care if you pay your car loan. They just collect a tiny little toll from every single vehicle that passes through their gate. Now, this business model isn't just different. It's incredibly powerful. And that brings us to why, especially in the world we live in today, it's considered by many to be the ultimate inflation hedge. Just think about it for a second. They don't have to worry about the risk of you not paying your credit card bill. That's the bank's problem. But they still get to take a small piece of trillions of dollars in transactions all around the world. This toll booth model is phenomenally profitable. I mean, we are talking about a level of efficiency most companies can only dream of. How profitable are we talking? Try this on for size, a 50% free cash flow margin. Let that number sink in. That means for every single dollar of revenue that comes in the door, 50 cents of it is pure cash profit. That is just a staggering number. And it's a direct result of this beautiful business model. So what does this have to do with inflation? Well, let's connect the dots. First, like we said, they have zero risk if people can't pay their bills. But second, and this is the beautiful part, when inflation pushes prices up, the total dollar amount of every single transaction goes up with it, right? That coffee costs more, that tank of gas costs more. And since their fee is a percentage of the total, their revenue automatically goes up right alongside inflation. It's like a built-in automatic raise. And that, right there, is the single most important takeaway from all of this. An interest rate cap is a policy that targets debt. But Visa and Mastercard's business isn't built on debt at all. It's built entirely on spending. As long as we're all out there buying things, they are winning. So that leaves us with one final and, I think, fascinating question. If government interest rate caps aren't the thing that's going to hurt them, what is? What's the real threat to this seemingly perfect business model? What could possibly disrupt the toll booth? Now that's a question worth thinking about.